Jeff Hyman, the startup therapist, is in the house with us today. Good to have you back on the show.
Hey, Angie.
So our topic today is venture capital money. A lot of companies, the first thing they want to do is raise some capital before beginning. So let's just break it down. What should be the first step if you decide to go this route?
Actually, the very first step is to make sure that you want to take outside investors.
Because you might not want to. Why?
Well, there's a few reasons. First of all, once you take that money, you can't give it back. So you've committed yourself to a path of three potential outcomes: bankruptcy, selling the company, or going public. And as you can imagine, most companies don't make it. But there are times when an entrepreneur's needs and interests diverge from investors. So you really want to think about that decision. The next thing is to think about which firms, right? There are 1,000 venture capital firms in the US, and there's actually many more if you think about angel groups and individual investors. So you want to focus on firms, and I typically tell people to think about the best 10 matches that have that invest in similar types of businesses, whether it's hardware, software, etc.
Sure.
The right stage, geography. Silicon Valley venture firms don't typically invest outside the Bay Area. So you want to think about the right firms and then get personal introductions to those firms.
Because all of those reasons could really make a big difference in the long run, because you also want a venture capitalist who believes in your firm and your company as well, right?
It's really a marriage, right? You're essentially getting married to this firm. So the average venture capital investment is between 5 and 7 years. You're going to have them on your board of directors. You're going to be very involved with them. And so it's really a marriage. And for that reason, I advise entrepreneurs to build a relationship before you actually pitch, before you take their money, so you get to know them, to see if you're compatible, to see if you solve problems the same way, and if you think about the business the same way.
Let's move on to the third topic, which is the ask. How do you go about asking for the money?
Well, the very first thing you do is you over-prepare. You need to understand your business inside and out, competition. You need to understand a lot about the specific venture firm that you're investing in and the individual partner at that firm. What other investments have they made? How is your business similar to those other companies? Do the work for them. Make it easy. Make it an easy decision for them to write the check.
Are you writing out a proposal?
Well, you're making a pitch. You're making a presentation, but many entrepreneurs go in and they make a formal pitch, or they try to. And investors want to ask questions. They want it to be an interactive discussion, a dialogue.
Okay.
So if the business doesn't go well, what are we going to do? If this assumption doesn't hold true, how will we react?
I hate to go back to this, but you see it all the time on Shark Tank. They're asking the questions that you will likely be asked if you are in front of a venture capitalist.
That's right. Think about the question, anticipate the questions, and you'll see the same questions asked over and over. So you really need to master those questions. It's also okay to say, I don't know. That's a great question, but then circle back promptly with a reasonable answer.
That doesn't raise a red flag if you say, I don't know?
It's certainly better than knowing the answer. It's not as good as knowing the answer, but it's way better than trying to BS a professional investor.
That's
Just say,
that's a,
and you can praise them and say, that's an awesome question. I've never heard that question before. And then later that day, you get back to them and say, I've thought about your question, and here's the answer.
Jeff Hyman, you are smooth.
I've done it a few times.
Thanks for coming on the show.
Thanks, Angie.